Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Fraser Lundy, manager of the Hermes Global High Yield Bond Fund. Hi Fraser.
Hi Emma.
So I thought we'd start with oil. I seem to be inviting everybody who sits in that chair to start with oil at the moment because it is so prevalent on investors' minds. I know that you are light on oil across this fund and indeed the two others that you run. There have been a lot of headlines about how oil is going to pull down the entire high-yield bond market. Is this true?
Well, it's certainly been true over the last 12 to 18 months because the correlation between oil and high-yield returns have never been this high. There's some good reasons for that, but like everything else, it throws up some opportunities. We think that there are some opportunities within the energy space, particularly on the pipeline side. But equally, it's throwing up opportunities as a second derivative to that in places like basic industry. So actually, we think the real opportunity here is in the sort of tier one players within the metals and mining space globally.
And so I suppose it's a bit like with the equities within this sector. Just because everything's been dragged down, it doesn't mean you should throw the baby out with the bathwater.
Yeah, there's definitely a relatively fat tail on the high yield universe right now related to stressed and distressed oil plays, and essentially they are option trades at this point. So you know that certain companies are going to be okay if oil's at 50 or 60 or 70 or 80, and you can place your bets accordingly. We don't prefer to place bets in that way, but as you say, you know, in all of that malaise, things like the pipeline space, things like the high end of E&P, where you've got some very low-cost producers, we think that they are not option plays, but actually pretty sensible relative value investments at this point, and that's where we're seeing the interest.
And you're also seeing some opportunities in metals and mining, aren't you?
Yeah, I think there you've got to the point where dividend yields essentially mean nothing, and that is the equity market saying, you know, to a certain extent, we don't care about taking near-term pain, just make sure that you're alive in 2 or 3 years' time when you have a turnaround in the commodity cycle. And from that point of view, if you believe that, which we do, it's a great time to be investing from a credit story, because all you're seeing is dividend cuts, capital raises, asset sales, very defensive behaviour by a lot of the tier one players. And to a certain extent now you're in a bit of a win-win situation, because you know that they're strong enough from a asset quality and cost of production point of view to withstand further pain. And equally, the longer that goes on, the tier 2 and tier 3 players are likely not to survive. Therefore, they're going to be in a very strong position coming out of this cycle. Or commodities just go up and therefore they go up. And you know, as a space, I still feel it's a very under-owned space. And you know, in a relatively illiquid and sentiment-driven market, I think that's important to recognise.
So essentially, these are quite high-quality issuers who perhaps are rewarding you above the level that you perhaps suggest they should be, just because there is so much negative sentiment around the sector.
I think that's exactly right, and I think, you know, part of this is about fund flow driven or sentiment driven, or maybe just a need to manage volatility within certain sectors. But when I look at things like, for example, BHP hybrid bonds or Vale in Brazil, and I look at the relative value that they're offering as very likely survivors in that space, I think they look very favourable versus some areas like European financials, for example, right now, where I think the type of sentiment and ownership levels are much stronger.
Contrary to quite a lot of your peers, you're actually not that positive on Europe at the moment, are you? Why is that?
I mean, there's a couple of main reasons. The first is related to the fact that globally we're entering a rising default rate environment today. There's no doubt about that. And I think people will probably be reminded that in Europe, going bust is a mess. You know, you can spend years in court in places like Portugal and Greece and France, and they're different in each place. You have a bankruptcy regime which is non-homogeneous. So from an IRR perspective, as a distressed investor or as a credit hedge fund, I think the appetite to go through 4 years of bankruptcy to then get what is likely to be much lower recovery rates this time around is going to be pretty low. The recovery rate point, I think people haven't really understood well yet. We've lived through 6 or 7 years now of what I would call cov-light world. So either on the loan side or the bond side, documentation has been getting looser and looser in the search for yield. And that's allowing companies to survive for longer, partly by being able to issue secured debt or issue security to revolvers to keep them alive. The net result of that is that in the longer term, when they eventually do go bust, the recovery to unsecured holders is going to be close to zero. And that matters a lot, especially in a place like Europe where you're going to be sitting around waiting for it for a few years.
So you're chucking good money after bad, really?
Yeah, I think it's just a poor risk-return trade-off compared to what is offered in the US and in emerging markets today. Added on top of that, you've got the liquidity-related premium, which I definitely don't think is there. Obviously, on the US side, you had a re-injection of liquidity premium in November, December time when you had some funds gating their funds, and a real question mark over that asset-liability mismatch. You didn't have that in Europe, and I think if you had have done, you would have seen a much bigger injection of liquidity premium. So those two things together, I think, make me pretty conservative when we think about that space.
Fraser, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.